All right, well, we capped off one of the strongest 3-week periods we've seen since last year. We had a couple of these almost exact same 3-week periods last year, so we'll talk about that. We'll talk. What's interesting is last year. Last year's March timeframe that we talked about before, the options market had priced it in. I'm going to show you today what the option market had priced in for this particular last 3 weeks, and how we differed to see if there's any difference there, and then and how long this move should have taken according to what the options market had priced in. So we're going to take a look at that, take a look at the technicals behind this move, how they compare to previous moves, how significant they are, how bullish we have been. We'll take a look at what's driving it. Things changed this week than what we saw the prior 2 weeks. We'll look at those changes and our trade idea as always. We also are starting our Black Friday sale that's going on through the end of next week. There's a code at the top of our website. I'll show you here later on how to use that. But you'll see it at the top of our website at the notification bar. Just click on that. Use that coupon code for Black Friday, and that will get you 20% off of our premium services there. So check that out. So let's go ahead and get started. Today is Friday, November the 17th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. If you're following us on our website, check out some of these other things on the right, including our Market Outlook live video. Come down to the bottom, click this heart. It opens up a new tab. Here, click that like button. Same thing here. Click this thumbs up icon. It takes us to this tab. Hit that like button there. Again, that helps get our content out to all of our followers. As I mentioned before, here's our Black Friday sale, where you can be able to sign up for our premium services for 20% off by using that code. To get to that coupon code, you click on that button to join, and then it takes you to this page. You come down to the bottom, fill out the information, and then right here where it says have a coupon, click on that and then type in Black Friday, right? And that's how you can be able to take advantage of. So you have to make sure you click that have a coupon question mark. It opens that up and you can type it in there. All right, let's go ahead and get started with the market forecast indicator on the S&P 500 like we always do. And you can see again the finish to the week. So we had 4 up days after starting off with a rare Monday down day, right? Which is what, the second time in 18 weeks or 19 weeks that we had a down day on a Monday. Every other day was up, even if most of that was on Tuesday, including the gap on Tuesday. We did get up to that 4,500 level area, a little bit above it. That's a 78% retracement of this decline, so it gets you back through the resistance of the Fibonacci retracement, and then now into this area. Now, we've been here before, but we'll see if that ends up breaking through this go around. And of course, we're well above the moving average, over 4% above the moving average. Intermediate lines well in the upper reversal zone at extreme highs, 97th percentile practically, as you can see over here. The near-term line's dropping, but just barely out of the reversal zone. The momentum line had dipped, a little bit of an intermediate confirmation signal again, and we bounced out of that, and now it's out of the oversold levels. That's the S&P. Of course, the Russell's been a little different, though. Russell really caught up in a big way on Tuesday, had a really, really big move, but then had that upper shadow and a reversal on Thursday that the other indexes did not have. And we did rally, but again, not up past where we were pretty much on Tuesday at the close. The intermediate line did go up, but you see the near-term line crossed below. It's a bearish crossover between 20 and 80 when the blue line crosses either above or below the green line. In this case, crossing below it is bearish in this regard. So we'll see how bearish that is, how long. Again, the momentum line was oversold yesterday on the down, what was a down day, and remember the S&P is right at its 78% retracement of this decline, and the Russell is barely above the 38% retracement. So it's still lagging behind pretty dramatically, despite the catch-up move that we had this week, at least on Tuesday. Tremendous move to the upside. Again, we are 4.5%, and we have dark green shading and green line. Of course, the Nasdaq's been the big driver of this momentum. It's been, in fact, it's pretty much near 52-week highs. Intermediate line looking almost exactly the same as the, also had the bullish intermediate confirmation signal and bounce up, momentum line bouncing up, we're 5% over. And then your Dow, which is kind of in between, large cap index, but has been more correlated at times with the Russell. And again, you can see, really strong move up higher. And if I were to do the Fibonacci lines on this one, here we are here again, right at that 78% Fibonacci retracement. 3.5% above the moving average. Intermediate confirmation signal yesterday, bouncing back up here today. Now let's take a look at the weekly versions of this, and you can see the strong move that we had this week. It's third week in a row now to the upside. You can see where we are again. The near-term line, the momentum line got above 80. The near-term line's way up above 80. Momentum line is already dipping a little bit, and the intermediate line is rising, but still below its market sentiment. That's also still rising. You're back above the 30-week moving average by over 3.5%, 3 2/3%. So a good market forecast pattern from that perspective. The Russell 2000 is a different story. Again, you can see we're not above the moving average. We're actually still below it. The intermediate line is actually still below the 20th percentile, and the near-term line, momentum line, did not spike up to strong highs. It dipped its toe above 80, and the near-term line appears that it may be peaking here. We'll see if it does or not. If we end up blasting higher, but we're still more than 1% below. So dramatically different chart, as you see, like, of course, on the NASDAQ 100, which did get a bull tag on the weekly chart as well, and we immediately reversed in 3 weeks, and we're back up to new highs with a strong short-term sentiment. Finally, one more chart to look at on the market forecast, since it was the end of the options expiration cycle, and you'll notice here that after getting a bull tag, like we did on all these other bull tags, you see immediately we bounced up on the next month expiration cycle on the next bull tags, and we did here too. Now, granted, we didn't extend higher on any of those. We eventually did on this one, but it took multiple months to finally break out. And finally, it didn't actually do that until this June when you finally broke out after that bull tag. So you did have a rebound month, but as you saw here in July, that failed, and then you had a rebound couple of months at the end of 22, and then that one failed too into that bull tag. So there's precedent, and again, the near-term line has crossed below its markets. The market sentiment, the intermediate line, is still below market sentiment, which is falling, and the near-term line is actually still below the intermediate line too. So it's rising, and it looks good, but we're not quite there yet, and it remains to be seen if we'll. Remember, this is a monthly chart. Sorry, this is a monthly chart. This is based off of the month of the options expiration. So here's the options expiration. So again, you get the bull tag, we bounce up. You get the bull tag, we bounce up. We get the bull tag, we bounce up. But we don't continue to go up until this last one. But like I said, it was that kind of June time frame that we finally broke out, and here we are. We didn't quite get a bull tag, but we came really darn close and oversold in the short-term sentiment to an extreme on the momentum line, and then we bounced up. But again, intermediate line still below market sentiment, near-term line still below intermediate. We're 7% above the 30-month moving average, but not necessarily breaking out here. And we'll see if we, like I said, we've seen this before, right? We've seen a big month like this before after this bearishness here last in 2022. And, again, we need to avoid having that kind of month that comes after. Here's the Russell 2000. And you can see the Russell, there's that same period last year when we had that nice little rally off of its bull tag. We don't have a bull tag now. The Russell 2000 is actually in dark. So the Russell 2000, according to this chart, is actually in bear market mode. I mean, you could argue right now that the Russell is in a bear market because you got dark pink shading and a red line on the monthly chart. The near term, the intermediate line is way below market sentiment, not even close. The near term line, it is between 20 and 80. The near term line crossed up above it. So we'll see how long this bullishness lasts for the Russell. And we're still 7% below the 30-month movement. So dramatic difference here between those mega cap names and the Russell, which is itself in bear market mode here. Let's take a look at some of the other, let's look at the other weekly chart that we look at. You can see we've had 2 consecutive months, or 2 consecutive candles of 3% or higher. Again, very similar to what we saw over here. Now the question is whether we get this kind of candle next week, right? We talked about how very similar these 3 candles are to what we saw here. And we're going to at least start off with a pretty good bullish candle next week, or this week. And it's only a 3.5 day trading week. And it is traditionally a pretty quiet week because of Thanksgiving. We do have NVIDIA earnings. So, and then, 2021 over here, it was not very quiet right here that week of Thanksgiving. So we'll see if that ends up being the case this go around. But as of right now, it's showing a pretty bullish pattern on the S&P. Of course, the Russell 2000 is a different story. At least it is bullish. There is a lower shadow there. It's more of a transition, but at least, it's a pretty decent sized body we haven't seen for a while. It's not the biggest body. There's been bigger than this, but we are above the average, and the PPO is negative, but it's rising, and you are in death cross environment, but you got a green arrow. So, again, small signs of hope for the Russell, but much different picture than what we're seeing on the Russell than what we're seeing in other indexes. Here is the 3 green arrow chart for the 3 green arrows all across the board. Again, we looked at the weekly chart before, and you can see they're giving you 3 green arrows. The Nasdaq just barely, well, the S&P and the Nasdaq both gave you 3 green arrows this past week on the weekly chart, right? This would be the weekly chart. And then, of course, that's not the case for the Russell 2000, which actually still has 3 red arrows. We don't even have a single green arrow on the Russell 2000 on the weekly chart. So again, it goes to show the dramatic difference between the major indexes here, which, heavily influenced by this one. The Dow is not. The Dow is not as heavily influenced by the mega cap names, but the Nasdaq especially is, and the Dow is increasingly more and more influenced by those names. The Russell, of course, is not at all, at least directly, by those mega cap names, and that's why there's a dramatically different pattern that we're seeing. The S&P has a good bullish pattern on the DMI. The Russell 2000, you can see, does too. You're above 30. You're not below 20 on the negative. That's why your ADX is actually still falling, despite what appears to be a pretty dramatic move here to the upside. The CCI is still kind of failing. I mean, you're pretty close to like extreme highs on the RSI, but you're not getting that confirmed at all by the CCI. Now, granted, the weekly CCI is really close to crossing above 100. So we got to, over here, we got to 97 before rolling over, and then eventually crossed above. So we'll see if we close here at 94, or if we end up getting above by the end of next week. So you're poised for the CCI to enter bullish territory, but your RSI, which you would expect should be in bullish territory too. We got above 50 and eventually went above 60, so we're now in bullish territory in the RSI. It's just not being confirmed at all by that daily CCI pattern. You look down, and you can see why. I mean, you have, a volume, you have a money flow, which, again, here we're right here right now on price, but you notice we're not there on the volume, despite an extreme move higher in the money flow index. And that's one of your main reasons why we're struggling there. Ichimoku cloud, you are through the cloud. There is a green crossover. You do have an intermediate trend strength going with a strong rate of change on the red line. The Russell 2000 is actually at least in the bottom half of the cloud. You're close to getting a crossover, and you do have a weak bullish trend. You don't have an intermediate, and you have small positive rate of change. So you can kind of see that, again, the differences there. The S&P did close outside the Keltner channels all week long. Well, after Tuesday, it closed outside the Keltner channel all week long. Very high momentum. You can see it's one of the higher levels of momentum that we've seen in a while. So, sorry. Let's remove that, and let's just do this so you can see kind of where that momentum is. So I will do this, and let me move that to the top of that candle. All right, so here's where that momentum is relative to it's the same kind of momentum we saw last March, same kind of momentum we saw in August, similar to what we saw coming off the COVID low. Obviously a much bigger volatility index then than we have now. In fact, if you look at, I had this chart up and I didn't show you. So these two lines right here are significant. This blue line was a 1 standard deviation move based off what the VIX was on, where the VIX was at on 10/27. So that kind of gives you an idea of the kind of move going into expiration that the options market was pricing in. Of course, this is the move we got. So that's how much more. So based off of volatility, this is the move. By the time we got to this price level where we're at right now, that's the time frame it would have taken to get it. It would have, based off the volatility, at the upper limit of a 1 standard deviation move, it would have taken all the way to mid-January to get up to 4,500. And of course, it got there here 2 months earlier. So 2 months earlier than what the options market priced in, and way higher. Like the options market had priced in a move towards 410. That would be where it started. To 426 is where the options market was priced in for. So this move here was nearly a 2 standard deviation move. So when you're thinking, and you've heard some people say, well, we're so bullish now, you can expect another 5 to 10% to the end of the year, because that's pretty much what it would take. I saw Tom Lee reiterated his 4,800 target by the end of the year. It's the same target he had last year and the same target he has this year, right? The end of year, 4,800. And of course, that would take another 6% move to the upside from here after what was a 2 standard deviation move that pretty much pulled forward 2 months of trending to the upside in 3 weeks, right? That's essentially what it did, right? We pulled forward a 2-month trend into a 3-week time frame. So now we have 6 more weeks. How much further, how much can we add to a 2 standard deviation move already for 6 weeks from now, when we've already pulled forward those returns and then some? Because again, it goes all the way out to January 16th. So that's an issue, and you see that with with the Bollinger bandwidth as high as it is. I mean, that's a high Bollinger bandwidth. We haven't been that high in a very, very long time, right? Since the correction. But again, like I mentioned, I think I might have mentioned to you before, at least I tweeted out, that it is very rare for, you can see there's some other instances over here where we got bullish. This was the last time, 17 and 18, that was the last time we increased from a low bandwidth for a 150-day range up to new peaks on a bullish move, right? And of course, that ended up being a kind of a parabolic move, and we failed. And very similar to what we're seeing right now, right, where we broke out of the 150-day range on the bandwidth to a very strong level, right, about the same level as what we got in 2018, but on a bullish move. Usually you get your strong bullish moves like this one, which was about the same, but inside of a larger 150-day range, because the bandwidth expanded with the down moves. So the fact that we did not expand the bandwidth of the down move, and not only that, but we are expanding this bandwidth to high levels without really getting into the upper quartile. Like, we barely gotten into the upper quartile for just a few days. Whereas most of the time, when we, like over here, you can see you got above the 100th percentile on that breakout. You were, and even earlier, you got on the first initial surge, you got above the 100th percentile, and then you got above it again, and you were well above the upper quartile. So you see this move over here on the left, dramatically different than the move we're getting now. So kind of another sign. It's like, dang, like this is not common to get. We already saw how big of a move it was relative to what the options market was pricing in. Well, this is the type of move we're getting relative to the volatility, like based off the Bollinger bandwidth. So that, again, it's literally a market move that came out of nowhere for no reason, right? We weren't, as I mentioned to you before on the McClellan oscillator. Like, this was not a washout low point, not even close to what, like October. October was a washout low point. This was not a washout low point. In fact, it was kind of a divergent move. Yes, the summation index was low, but we weren't breaking below minus 100, and we like surged as if we did, right? So, again, we've seen that pattern play out before. We saw it back over here where we surged here in May, for an example. We weren't coming off of a washout low point, yet we surged anyway, and that surge didn't hold up, and neither did the one in August did it hold up. So here we go again on another surge to the upside off of a non-break washout low point that in the past precedent has been a failure. Like, those have failed for obvious reasons, and we'll see if that ends up being the case again this go around. If you take a look at the let's look at the intraday range first. and then we'll get to these charts. So of course we have a new 4-week high point. So again, you can see all week this week we had new highs. In fact, you're about to hit zero now on the lows. So the low is moving over here. And remember, the range, that's a high level for a range, again, on a bullish move. It's not common for it to get above this 9% level on a bullish move. It's typical for it on a bearish move, but not on a bullish move. Again, coming out of nowhere, right? And you can see the gap that's still there from Tuesday. If you look at IWM, we actually filled in, so we came a lot closer to filling in some of that gap. Remember, we already filled in this Thursday gap over here. But S&P, you can see the precarious situation we're in going into this week, because we went so sideways all week long after the gap up after CPI. We went sideways for so long with very, very minimal ranges that it leaves open a tremendous gap in volume to fill in that gap on Tuesday and come down towards 40.37. Again, fill in this gap potentially from the 3rd of November that we have already filled in on the Russell 2000. So a pretty precarious margin of safety going into, and you can see just like the rest of the week, we haven't had big ranges at all. In fact, today was the smallest range out of all of them, and the volume was still right around average. So you're still, you got very, very light ranges, bringing the ATR back down towards 1%, not through it yet, and the volume's down. So those are typically bullish there, but to an extreme, because even the VIX itself dropping below 14, still maintaining a level right around this 87.5, and then your VVIX dropping to below 22, which is not common for it to get there, much less stay there for a while. So here we are, like the last time we got there this year was the very end of August, and then the VVIX rallied right before the VIX itself rallied. Very extreme lows on the VIX. Just this 3-week drop in the VIX is one of your bigger 3-week drops. But what makes it even worse or more dramatic is it came from just barely being above 21. So again, it's one thing to get this kind of a drop in the VIX when the VIX is in the 30s or even the high 20s, but to be barely above 20 and to have this kind of drop in a short amount of time, again, tells you that we had this roaring bull come out of nowhere, and there wasn't a roaring bear that necessitated it. And so you wonder how much of this bull is, how much backing there, how much substance there is behind it, or is it a lot of, as I mentioned before, a Venezuelan phrase, is it more just pura bulla instead of actual? Because again, it's one thing when you have a washout low point like the end of 2018 off the COVID low, where you had dramatic washout of sentiment and volatility and volume, and then you bounce right off of that washout, and you have the dramatic rallies because you're washing out to the downside. That's a true breadth thrust, and not the case here because we weren't washing out yet. We didn't have a dramatic sentiment to the downside or volume or money flow to the downside, and we've seen that, like I said, in the money flow, because we're not getting that dramatic money flow to the upside either, enough to offset what the move we had to the downside. All right, let's take a look at what's driving this price action this week. And again, here's the 3-week return. You can see the Qs now are nearly up 8% over the past 3 weeks after being down 4% at one point, and IWM rebounding, though still down here with VNQ and TLT again over the past 3 months. Let's go to, remember this whole thing started back on July 31st is when we peaked on most of these stock market major indexes. Since then, the Qs have gone up to new highs. The Qs are up 0.5%. IWM, SPY is still down 1.5% from those highs, and IWM is actually still down 10% from those highs. So it kind of gives you an idea about the rebound we've had over the last little bit, especially from IWM. The Qs at one point were down 10%. SPY was down about 10%. IWM was down 18%, along with VNQ and TLT down considerably, and they're still down. At least TLT is still down considerably there, despite a rally up here to the upside. Of course, the dollar is off its highs, but still strong over the period. And commodities had been strong. They've pulled back in the last little bit. Let's just take a look at this past week that was. So we'll come over here to November, and we'll go back to this past week that started on Monday. And of course, we had the big gap there on Tuesday. Let's go to like a 10-minute chart. Had the big post CPI gap on Tuesday that prompted IWM to go up 5% on the week, and real estate, remember, those were the biggest losers and still are by far the biggest losers, even with this bounce that we've had. The dollar being down nearly 2%. Commodities were down late in the week, rebounding on Friday, but late in the week. And high yield, you can see, was underperforming TLT for the week. And we'll see if you take a look at here. HYG, well, first of all, QQQ finished again for the third day this week, finished below the 17-day moving average against IWM as a correlation with the S&P is rising. Still negative, but it's been improving, getting back to where it has traditionally been more positive. Let's take a look at HYG relative to IEI, not TLT. And you can see, despite HYG outpacing, or TLT outpacing HYG, IEI did not. So HYG ended up finishing higher. Again, that's got a positive relationship with equities. It returned to back being positive. So that's still, that still kind of shows, the lack. I mean, shoot, it is at its multi-year highs here. So it's like, again, remember the S&P hasn't formed new highs since that 2022, and this ratio obviously has easily formed new highs. Again, this ratio also strongly positively correlated with the S&P, has not formed new highs since January, since really pre-Thanksgiving in 2021, but it is forming new highs for this calendar year, and is, again, look at the move higher it's made. Again, strong positive correlation. RSI is above 70. The CCI is well above 100, well above or close to the 150 area. You see the DMI. So in pretty strong long-term PPO as well. Has been stronger over here, but pretty decently strong bullish appetite from that perspective. Of course, the big thing we kind of keep our eyes on is the new highs and new lows index. And you can see here, again, this index has got to get above like this 100 level mark and stay above that, right? That's where trends really start. And you can see we didn't do that over here in August of earlier this year. We didn't do that in some of these other instances where we peaked. Of course, we did do it over here when we did start this move higher, and this one over here. But again, so far not. In fact, I mean, we're barely positive. We're at 2 net new highs versus new lows in the entire New York Stock Exchange and NASDAQ composite together. So, the average is really ramping up pretty strongly, getting back up. It's still, it's still lower now than it was in either of these two instances on these lows. Of course, let's go back out to that 3-year time frame. You can see it's actually still not. It's higher than where these lows were during the correction, but it is lower still than the low points on these instances here, and it continues to move higher. So, but it is interesting to see again the ratio here of number of stocks above their 200-day moving average versus how many stocks are above the 50-day moving average. That ratio dropping well below 0.1, dropping all the way to 0.8, which, as I mentioned before, in the past have coincided with these peaks on the S&P when it's dipped this far, taking advantage of such a dramatic move to the upside. Again, kind of a paper bull type move to the upside. When we didn't need, we weren't coming off of a washout low point from that breadth standpoint. When you look at the breadth here, we were hardly coming off of a washout low at all, and yet we had the type of move that you would expect that we were coming off of that. Remember, that rate of change over 15 days is one of the highest 15-day rate of changes that we've seen, and the other instances that they've been this high, and you saw again the volatility was definitely not, the options market was not pricing in anywhere close to this kind of move. Again, a reflection of the fact that that volatility wasn't this high. Here's your 3-week move, and you go back 5 years. Again, you're going back to again the failure there at that March peak, which we've talked about before, the same failure here at the August peak. But then again, you've got other moves coming off of levels where volatility was really, really high to get to these points. And volatility, of course, was not very high, as you saw, was barely above 21 when this whole thing started 3 weeks ago. It was just barely above 21 there, and was barely above 95%, much less above 100. And a lot of those other instances that I pointed out, where we had this kind of 3-week move, was well above like 105, 115%. And keep in mind too, when you look at that same rate of change and you look at the Russell 2000 over that same time frame, let's go back to the same 15 days. So the same 3-week pattern here. And again, until that Tuesday move, we were only up 2% over the 15 days. And then now even the Russell has gone in one day, because remember, we're at the same level now than we were on that Tuesday. So essentially in one day, we are as high as we've been, all the way again since that August peak where it just went insane. And even the May peak there, and some of these other instances. And again, remember, the volatility was not high like it was, like coming off the COVID lows or coming off the fourth quarter 2018, or even coming off of the pre-election lows. We had a dramatic move in a short amount of time. Obviously, the vaccine had a big deal with the reopening trade, which was highly correlated with the Russell. So again, it's like this low point was a bear market low point, or a correction low point, a washout of a correction low point. But again, not when you see like this McClellan oscillator here. Again, you go back to that fourth quarter 2018, look at that washout there. Of course we're going to get a strong move to the upside. Look at COVID, look at the washout there. Of course we're going to get that kind of move to the upside. No washout here. And you get this kind of move to the upside, and it's like, well, wait a minute. And like I said, even the Bollinger Band not even up into the upper quartile. Obviously, your sectors are going to have a predictable performance. You can see XLK and XLC over the past 3 months. Again, if I were to go over the past 3 weeks and how things have performed, you can see the biggest winners: XLK, XLY, XLC. That's not surprising. Real estate also not surprising. It's kind of been lumped in those areas. Financials, a little surprising that it's been ramped up that much with the yield curve still as negative as it is. And you can see your safety trades and energy, which had been a winner, lagging behind. Again, going back all the way out to when this all started on August the 1st. You can see here that you have XLK and XLC now to positive gains, and nothing else is. And staples and utilities are still your biggest losers, and it had been your biggest losers, along with real estate, interest rate sensitive areas. So not your typical risk off move, and definitely not your typical risk on move sense. Let's look at just this week that was, and we'll come over here to November the 13th, and let's go 5 minutes. And you can see that, again, real estate, materials, utilities, and financials and industrials, XLY is up there, but not really XLK or XLC. Staples is up there, but, is lagging, and energy was lagging and kind of rebounded, but again, not your typical risk on trade here, when that was your biggest winner, was XLK, XLY, XLC, and has not been. As I mentioned, going back out to the 3-week period there, they were your biggest winners. And now you can see even all the way up to the beginning of this week, and now they've really slowed down those gains coming out of these first 2 weeks to where now they weren't the biggest winners over the past 3 weeks. We've had some of these other sectors outperform, and that's, again, a shift to a different kind of risk appetite. So for our trade idea today, I want to take a look at eBay. Let's take a look at eBay here. And it's been on a nice good rally, back up just like everything else to its moving average, but stopping at its moving average, unlike everything else. Had its earnings announcement, gapped way down on its earnings announcement, filled in almost the entire gap before petering out, right? And then got that long upper shadow like the Russell did, and then did not rebound like the Russell did. And the near-term line falling below the intermediate line, which is the bearish pattern we talked about. The intermediate line is still rising, but it's in the lower half of the chart, hence the light green shading. So you can see like it's not rebounding. In fact, when you look at its weekly candles, you can see you're getting transition candles, but these transition candles aren't bullish candles, right? And so more than likely, when you get transition candles on Hakinyashi, they're not bullish, in this case for bullish reversals, but they're not bullish candles in actuality, then they end up turning, instead of reversal patterns, into continuation patterns more often than not, or continue to stay sideways and trending sideways. Obviously, when you look at the 3 green arrow chart, we have the red arrow on the moving average, but we have green arrows on the stochastics and the MACD still. And we've had at least two, if not one, green arrow for most of this time. So it's been kind of in that convergence mode. You can see we've been trading in between the 17 and the 30-day moving average for the past week, as that MACD is approaching 0, but the histogram is rolling over, and the stochastics, you can see, is converging on its moving average. Looking at some of these other oscillators, if you take a look at the CCI, the DMI, you can see you still have a very strong bearish pattern, well above 30 on the negative, and falling back down on the positive indicator. Looking at the RSI and the CCI, you can see they stopped at bearish levels, staying in the lower half of the chart, never really getting above that positive 100. And you can see on the weekly version of that, we're still very strongly in the lower half of the chart there. Looking at the Ichimoku cloud, we are well below the cloud, very strong rate of change, negative rate of change, and near a mature bearish trend still. So we're still in a very strong bearish trend, and that hasn't changed. The Bollinger Bandwidth, you can see here, Bollinger Bandwidth has been declining as we approach the midpoint of the chart, but not really getting into the upper half of the chart. And you can see the bands themselves are inside the Keltner channels, but not producing very strong momentum at all. Very similar to the last little bullish momentum we had that failed, and expect a similar pattern to occur. So as a result, what we decided to do on this trade was to sell the 41 contract here and buy the 43. So what that does is, if you come down here, let's see, let's go to the Analyze tab. So let's analyze this. Yeah, there it is. So you can see where that break even is. So again, full position size. We don't have to worry about earnings. We've already been through the earnings. Get to that full $1,000 earnings, and put my break even, set my slice to break even here, and then set that slice to the chart. And you can notice here that we'd have to get all the way back up above this previous high point for us to get to that break even, and then some. And of course, at that point, we'd be willing to lose 350. So you'd have to get right into that 42 area plus, which is way up there. So we'd be clearly getting above the 4-week high point. But if we break down into this gap from last Tuesday, similar to the Russell, right, then you'll probably get to your 50% of maximum gain, which would be $175 very quickly. And if we can get to it very quickly, then I can free up that $1,000 to go for another maximum gain somewhere else, considering that we still have plenty of time to expiration here. All right, well, that wraps us up for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Remember to subscribe to our YouTube channel. Click that thumbs up icon on the video. Comment. Join our website at marketscholars.com for free. Remember, you do have the Black Friday sale for this upcoming week that you can take advantage of. Like and follow us on Twitter as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.